Hello and welcome to today's video. Last Friday was historic, not in a good way. We had crash across the board with USA, China tariff talk escalating once again, and it really needed to happen. The only day that I was off because of the traveling. Bad side is that a lot of people get liquidated and that this might be the point of the end of the bull market. Positive side is that with this event we got liquidity reset as leverage was climbing higher and higher, which sets up healthier ground for strong Q4. My bet is still on strong Q4, but we will see in hindsight, as this is the type of event that makes it clear in the future, was this the turning point for the bull market or not. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice, I'm just one person with a microphone, always do your own research. So the stock market or S&P index fell over 2% during last week, which was the highest sell-off we had in 20 weeks. But the real story, however, was related to crypto market. Total market cap lost 7% or 500 billion, and at one point it was down as much as 24% from its all-time high levels. Some tokens further down the risk curve, like Atom, Jupiter, fell 90%, which even if for a brief moment was enough to liquidate all leveraged traders. DEX-es like hyperliquid stole the spotlight this time, as on hyperliquid open interest was halved by 50%. Risk management mechanism that is worth mentioning here is ADL or auto deleveraging, which is the last line for the exchanges in which they look to protect their solvency, and in return the biggest punch is absorbed by none other than us retail investors. In a typical liquidation, the exchange sells the traders losing position into the market, but when there is not enough liquidity, which is the case with most altcoins, that's when ADL comes into play. In this scenario, liquidation first starts with liquidating profitable positions, highest leverage and unrealized gains. Once those winning positions are closed, which may be shorts as a way of a hedge, then we are left with the losing long positions, which are now naked and become exposed as drawdown continuous longs get liquidated too. In practice, ADL shifts systematic risk from the exchange onto its users. So the platform comes at the first place, users are the second, just something in mind to keep for investors when it comes to exchanges. Now I would like to take a moment to compare this to traditional markets and why additional regulation could be a good thing. For example, in traditional markets, we have the presence of the clearing houses like DTCC in US, which guarantees settlement even if one side defaults. Also, we have circuit breakers, or more known as a halts, trading halts, which allow markets to pause when stock move drastically, and this allows for liquidity reset, and or it can be requested from the company to provide some kind of news to see if there is a reason for recent volatility. And now to take one example, well-known GameStop craze during 2021, when volatility exploded, brokers like Robinhood restricted buying because of the collateral requirements at the clearing house. This wasn't perfect solution either, but in this case no one's winning shorts weren't closed forcefully. The clearing system absorbed the shock and trading resumed once requirements were met. Now compare this to the DEX-es like hyperliquid. Altcoins like Atom collapsed to nearly zero within minutes, and with no circuit breakers and no clearing house in place, the only defense DEX-es had was auto deleveraging. But this is not saying traditional markets are better. Force broker restrictions in case of GME to slow processes behind clearing houses. However, it does demonstrate that specific risk can be handled with additional structure and regulation, but the key is to find the balance. And definitely, the answer is also not the centralized exchanges like Binance. There are parts of missing informations currently, but it is well known that they didn't like the rise of hyperliquid, and first thing they did is launching competitor in Aster. Second thing, what they did is heavy manipulation in price feeds of DEXs like Hype, carry their prices throughout oracles, which are getting the most weight from the centralized exchanges like Binance. So if Binance suddenly stopped working or providing up the data feeds, hyperliquid Oracle followed this by dragging its users down with it. While Binance looks strong, or to be exact, less bad in this story, because they didn't have as much liquidations as hyperliquid, that's just one side of the coin, as they are not obligated to provide all the liquidations as they are constrained by technical difficulties like APIs, while DEXs like Hype took the bad side of the coin, that by being on chain they can't fake their data compared to the centralized centralized exchanges. Now add extraction in terms of high fees, manipulation of the markets with leveraged traders in terms of knowing their liquidation price, and you just get a bigger picture of who the real villain in this story is. This being said, I believe now more than ever that DeFi is the future, but still there is a lot of progress to be made. And now we come to the conclusions. First, volatility is inevitable, but structure matters. The October 10th crash exposed how differently traditional markets and crypto markets absorb shocks. Stocks rely on clearinghouses and circuit breakers to spread risk, while crypto exchanges push systematic risks directly onto users. Second, exchanges protect themselves first. Whether it's hyperliquid ADL wiping out hedged positions or centralized exchanges pulling liquidity and underreporting liquidations, the house always wins. Your counterparty is not another trader, it's the exchange itself. Data transparency cuts both ways. Hyperliquid looked like the villain because it can't hide its liquidations, meanwhile Binance and Bybit underreport theirs, appearing safer than they really are. Fourth, Oracle design is a point of attack. When Binance leads a plunge, any DEX sourcing price feeds from it is dragged along. This creates systematic fragility where centralized exchanges can indirectly trigger mass liquidations on competitors. And the last, retail is collateral damage. 1 in 2 hyperliquid users were wiped out not because they were reckless, but because of how the system is designed. The lesson is clear. In both centralized exchanges and currently decentralized exchanges, user survival comes second to exchange solvency. I know all of this sounds depressing, but that's not the point. The goal isn't to scare you away, it's to show you the rules of the game. Once you understand how exchanges really work, you're equipped to play it the right way. Knowledge of the risks is what turns a losing game into one you can navigate on your own terms. And this is it for today's video. If you want to follow more of my content, you can read my content on Substack. Also, if you want more daily insights and market updates, you can follow me on my X account, and for more educational content you can check my website. All the links from mentioned sites will be in the description of this video. So this is it. Hopefully you liked my video. If you like it, subscribe and like as a sign of support, it means a lot, and see you in the next video. Bye.